Welcome to chapter 11, Stock Market Crashes and Market Bubbles. In this chapter, we have three objectives. The first is an introduction to fear and greed cycles. The second is to understand Warren Buffett's opinion on market psychology. And the third is understanding the accumulation of shares versus trading assets. So let's get started. I want all of you to imagine that you are walking or standing on a street at night and you are just kind of minding your own business, looking around, when all of a sudden you see a rampage of people just started running down the street directly towards you. You have very little time to react, but you just see this mass group of people running directly towards you. How would you react to that scenario or that situation? As most people think and contemplate that question, I'm sure that you would probably run in the same direction as the crowd of people and start running with them. It's not that you had to ask them why they are running or where they are running from or what they are running from. Your natural instinct, your human instinct is to turn with the people and start running. You might not know why, you don't even have to ask why, but your instinct is telling you that you need to get moving and you don't want to continue standing or walking there. Let's look at this next scenario. Let's say you are in a car and you drove past a restaurant and you are looking for a place to go for lunch. And you drive past this restaurant, and as you drive by, you see a long line of people standing there and they are all waiting to get in. So, what would be your natural inclination on where you should go to the lunch, which restaurant you should choose? And so, a lot of people would see the long line and think, wow, this restaurant has to be awesome. It has to be one of the best places. I could go for my lunch. So they get in the long line and they wait to get in. So what we are talking about here is human instincts. In the first scenario, we were just describing something that was fearful. In that you were standing on a street and a mob of people come running at you, and so your instinct is that you need to turn and run away, get out of there because something bad is about to happen. And the second one, you saw a group of people all standing in line waiting for something that has to be good. That's the only reason people would be waiting in a long line like that, is because something has to be good on the inside, and so you're willing to see what that is, and you're following the crowd's tendency to wait in the line. So, what we are talking about is our instincts. And an instinct is described as any behavior is instinctive if it is performed without being based upon prior experience or knowledge. And the two words that I highlighted, underlined, were without and knowledge. And I really want you to remember those two words as we go through this lesson. So I gave two examples of everyday occurrences that people could really quickly relate to and understand. And that's what a lot of people forget about whenever they understand how markets move in the short term. When I mean short term, I am just meaning a couple of years. 3 or 4 years I consider that is short term. I consider like 25 to 30 years long term. So when we are talking about how the markets move in the short term, you got to understand the fear and the greed cycles. And in our scenario, we are talking about people running down the street. That's obviously our fear cycle. And then greed would be waiting in the restaurant to get in there and eat delicious food and to have a great time. So when we talked in the last lesson about Mr. Market, we understood that Mr. Market is that person who would be giving you those clues to be an instinct-based trader. So since most investors based their investing on emotions and instinct, they follow the mindset of Mr. Market. And remember, instinct is without knowledge. So the solution to this is we have to got to become knowledgeable. We got to be base our decisions on facts as opposed to emotions. So as we look at this picture, you can see where Mr. Market up there yelling, "Hey everybody, come on in. I am making money. You can make money, and my neighbors can make money." That's your greed cycle. The mindset during the greed cycle is that a quick buck can be made, and that it's going to take very little effort on your part in order to make this some money. So what you have is you have traders who get in for one day and they make 10% on a stock and they quickly sell it and they think I'm going to throw it into another stock and they make some more money on that. Next thing you know, they are day trading, and they are doing this consistently day in and day out, and they are making some money doing it. And they then what happens is market corrects because you have value based traders who actually know what the value of those assets are, and they start trading them down because they are too high. And then what comes is the fear cycle, because people start getting scared because they are losing small amounts of money, and then they are losing larger amounts of money, and the next thing you know, they lose an enormous sum of money. And most people get scared, and then the mindset shift from making a quick buck to I don't know the value of these stocks, and I don't really know what I am doing, so I'm out here. And what they do is they sell all their shares and they lick their wounds, and they realize that the little bit of money that they did make probably lost it, or maybe even worse, they lost more than where they started out. So, how do we know what the stocks are worth? Is the tough question. And that's what we're really going to learn here. But I think we can all agree that the knowledge of a stock's value allows an investor to determine if the market is greedy or fearful. If you know what the stock's worth, then we know if the price is overvalued or the price is undervalued. And that's really the important thing here, that we have to know what the stock value is. And so Warren Buffett's opinion on this market psychology, he says the key is to be greedy when others are fearful, and to be fearful when others are greedy. So the name of the game is really accumulating shares versus trading shares. And you want to be a person who is accumulating shares. Benjamin Graham was Warren Buffett's professor at Columbia. He has a wonderful quote where he says the stock market behaves like a voting machine, but in the long term it acts like a weighing machine. And what do you mean by this is, in the short term, anyone can price a stock, anyone can say it's worth $10, $15, or whatever. But in the long term, the stock is going to be worth what its value is. And that's where you look at the scale where the value becomes absolute. So what I'm going to show you is, I'm going to show you two different traders. I'm going to show you both an value based approach and an emotional based approach. Our value trader is Sarah, and Ted, a typical trader who might not really understand all the different financial terms and everything that is there about stocks. So I'm going to go through how the mindsets of both of these traders work. So we have a Sarah on the top left, and she is looking at buying a stock at a company called Ford Motor, which is an automobile manufacturing company. And just that these numbers that I'm quoting, I'm going to throw in this example are not real stock numbers from Ford Motor Company stock. I'm just kind of using it as an example. So Sarah would look at the Ford Motor, and she would read through all the different financial data, and then she would look at it and say the company's earnings are $2 a share, and 18 of book value is a great margin of safety, and the 2% dividend is yield is okay. Overall, I think its intrinsic value is probably about $22 a share. So that's how Sarah would look at it. Now, emotional based trader like Ted, he would think, wow, I really like the company, Ford Motor. My uncle has a Ford Focus car that he drives every day. There are so many cars, Ford cars in our neighborhood. There is new Ford dealer branch is opening in the next town over there. I'm going to buy some stock in that company. And so that's how Ted thinks. So what we have is Sarah buys 100 shares of Ford Motor for $20 a share. So that's a $2,000 investment for Sarah in buying Ford Motor. And Ted does the same. Ted buys 100 shares for $20 each, and so he makes a $2,000 investment, both in the same company. So for whatever reason, we don't even know how to understand what reason, but the market drops. It could be based off of psychology. It could be based off of any number of things, but that's absolutely impossible to predict whether the market is going to go up or down. It's just not something you can predict. And so in this scenario, the market goes down, okay? It drops the shares price. So they're not trading for $20 now. They're trading for $15 per share. So this is how Sarah would look at this scenario. Wow, awesome. Although company had a little less earnings than I hoped for, which is probably the reason it is still trading for less. But it's still worth at least $20 a share. Since it's trading for $15 per share now, I would better get some more shares at this good price. So Sarah, looking at this, wow, wonderful. So they have a little less in their last quarter's earnings that they reported, but the company is still worth $20 minimum, which is a little bit less than what she thought it was worth before. And since it is trading for $15, she is going to even buy more of it because she knows it's a great deal. Now, Ted, this is how Ted would think. Oh my god, no! What in the world did I get myself into? I just lost $500. Ford Motor is a great company. How could it go down so much? I might need to sell this ASAP. I could lose everything otherwise because it's going to go down. So there you see there are two different mindsets. So let's go ahead and look at how they both react. So Sarah invests another $2,000 and this time instead of just getting 100 shares, she gets 133 shares because the market price is cheaper. So now she owns 233 shares of the Ford Motor Company. Now we look at Ted. He is just going to hold on to his 100 shares. He's a little nervous because he lost quite a bit of money. So let's just say like another 6 months go by and that the stock is still trading down that $15 range. So Sarah's mindset is I can't believe people are still trading this company for $15. She's getting a little bit frustrated. It's now worth $21 a share based on the new earnings and the balance sheet. I will buy even more shares. Another 133 shares are bought for $2,000. And now Sarah owns 366 shares. So Sarah, although the stock is still lower than what she thinks it's worth, which is a little frustrating for a value investor, and I will tell you, there's sometimes you have to wait for companies for a year or 2 years before they actually come back to that intrinsic value, that the value you might think that it's worth. But the key here is to think for yourself and to absolutely know that you are calculating the value properly and that you are looking at all the variables right. And so Sarah buys some more shares for $15. And Ted is still nervous. He can't believe that those shares have gone down so much. And so he's going to continue to hold on to it. He's not going to sell for loss, so he's going to hold on. So let's say that it's another 3 to 6 months pass by, and then the market price comes back to up to $24 a share, which is only $4 higher than where they both started. Now Sarah says, "Oh man, this thing is trading for more than what I think it's worth. Better start looking somewhere else for a good buy because this is overvalued." She thinks it's still worth $22, but it's trading for 24. So she stops buying it at this point. Sarah invested $6,000 and so then her profit because the stock is back up to $24, she has made $2,784, which is a 46% gain. Now the mindset of Ted is sweet. I knew this was a great stock pick. Just made some easy money. I think I'm going to buy some more. So he's going to buy some more of Ford Motor Company stock at $24 price because he made some money. He made $400 in profit on his $2,000 investment. So this is truly the difference between a value-based investor and a person who is really looking at the financial data versus somebody who is making their decisions completely based off of emotion. And you can see, the saying always says, buy low, sell high. And when you looked at these two scenarios, Ted was always buying when it was high, but Sarah was always buying when it was low. And whenever the price did get higher than what she thought it was worth, she immediately stopped buying it. She just held those shares. And if you're buying a dividend share, which I strongly recommend in the coming chapters, you are then going to collect the dividends on that as you just continue to hold to the shares. So something to think about as you look at how you invest versus how other people were investing. So what kind of trader are you? Do you typically sound like a Ted or do you sound like Sarah? and that's something that you are going to have to decide for yourself, and you are also going to have to decide whether you think that that's the right approach for you. Maybe it's not. And here is a question I really want you to think about in the long term. What do you think is ultimately determining the market price? Do you think Sarah is the person who is really controlling the market price? Or do you think it's Ted? So I would obviously argue that in the short term, Ted is controlling the market price. Teddy's Teds of the world are making the thing to go up and down because they are trading on that emotion, and they are following Mr. Market. In the long term, Sarah is the person who is ultimately controlling the value of that company. So if you like trade shares like Sarah, that requires knowledge, not instinct. And if you're looking for how to do that, you have come definitely to the correct place here with me. We have got tons of tutorials here to help you learn how to be a knowledgeable investor in a value-based investor approach. The chapters ahead is going to teach you all those things you need to know for calculating the intrinsic value. So that concludes chapter 11, stock market crashes and market bubbles. And in this chapter, we learned three objectives, which is an introduction to fear and greed cycles, Warren Buffett's opinion on market psychology, and the difference between accumulating shares versus trading assets. And thanks for joining me, and we will see you in the next chapter.